Greetings. Welcome to lecture 5. So we are moving on. Today we are going to be learning about production and cost. So as a bit of a recap, or rather reconnecting from our previous lecture 4 about consumer choice, where we spent some amount of time in studying the behavior of the consumer, what kind of guides them to make decisions with regards to how much to consume or what to consume. And, we looked at budget constraints and how we saw how constrained consumers are, and then how budget line comes in, and different possibilities of how they would consume their budget or their income on different options. And now we went on to find the best preferred choice by looking at utility. And so that is how we were able to go around the side of the consumer. And then we also discussed at the very beginning of the previous chapter that after that, we'll be looking at the producer, or rather the firm or the seller or the supplier. Would want to also study the seller, would want to study the producer to know what happens on their end as well. Okay. So, okay. So let me, excuse me, I'm just going to have to, excuse me, I need to do something here. Okay, so I need to pause a bit and then I'll be back. Okay, so whenever you think about every firm or every producer, we have to ask ourselves, why do they bother about making goods available? Because we know a firm or a supplier, we talked about demand and supply, and that, we talked about price and market, and that, for markets to happen is any situation, market is any situation or process whereby we have two main key participants. So we have, an exchange, right? Trading. So there are two sides, two main sides. We talked about buyers and sellers, right? So there's one who has to bring goods and services to the market, and then there has to be one who has to purchase, who has to pay and buy those services and goods, right? So we want to know, we already studied about the consumer or the buyer. We already understood why they're going to the market, what guides their decisions. Now I want to know about the supplier on the other hand. What really motivates them? What is the main objective for them to go into business, to go and bring commodities to the market? Okay. You want to know why, what is so, what is it about them? Okay. So every firm's motive, if you're to go ask now any big business that you can think of right now, okay, any company, any business that is producing goods and services, like if you go to a bank and ask them, why are you in business, right? A bank is providing financial services. If you go to a factory, if you go to, to the shop, to the shopkeeper, to the shop owner, okay, let's say the shop owner, and you ask them, why are you in this business? That's basically, what we are asking here. What is every firm's motive? So in as much as they will give you a number of responses, and these days as we're evolving, people have more reasons to do business, but there's one main reason that is mostly common to all of them. Okay, every business that really exists has one general motive, and that motive is about maximizing profit. First is realizing profit, and then maximizing profit. Okay, so you want your business to be profitable, you want your business to gain profit or to make profit, and that profit should be as maximum as possible. Okay, so that is like the likely success point. Whether they reach it or not, that's another question. But the point is, what is the main goal? What is the main motive? And then, of course, there can be a lot of other reasons that, businesses start businesses, all right? There can be, they have seen an opportunity, they want to save lives, they want to solve problems, to make a difference, to make an impact, all those things. But at the end of the day, profit has to be realized. Okay, so what is profit? What is profit? Okay, profit is gain, right? If you go and Google, probably you'll find something closer to that. Okay, profit is something gain. It's like it's a gain. It's like an increase. So when you think about profit in economics, we consider revenues. It's the difference between revenues and the costs. Okay, so if you think of a business, you just have to think, how much is it going to cost me? And how am I going to charge for this? And how am I going to sell this? How many pieces of this product? To how many people am I going to sell this? How much am I going to make? At what price? And then what are the costs that I'm going to incur to make this product, maybe shipped to the market from the factory until it gets to customers, until I get my money back. So I have to take what I gain in terms of all the money from sales, and then I have to minus the cost of doing all that. Then that's when I can say if it's, that's that the difference is what remains after is what we call the profit. Okay, so if this is the equation, if you look at this, okay, so if we use this connotation for profit, okay, so if profit equals to total revenue minus total cost, the difference, that means we would want this one, total revenue. Our goal or our most desired interest is to see total revenue is greater than total cost, because as long as it's greater, then your profit is going to be positive. But if it's less, then that's a loss, right? So for us to get a maximum now, a maximum profit, that means we have to maximize the difference. Okay, so either our total revenue must be as high as possible, or our total cost must be as low as possible. Okay, so we either have more revenues, we find ways to increase our revenues. So this could be, maybe you think about maybe change price, or maybe increase customers. So you increase customers, you'll have more sales, then you have more revenues, right? So anything that is towards this, then it will increase your revenue while your costs are the same. We assume that. Or while your revenue, you're serving the same customers, same amount of goods, same price, then you can see and how you can minimize, okay, how you can minimize your costs so that you can have a maximum profit. Okay, so those are different alternatives that different firms use to maximize their profit. Okay, so we'll see later, but for now, when we say total revenue is your total amount of sales. So think about any products that one would be selling as a business person. Okay, when you sell, total revenue is total sales. So how do you get total sales? You just have to, if you have set a price for your product, so let's say you're selling cups. So if you're selling one cup is 2,000, and then you're selling 100 pieces of the quantity. So you have to, is price times quantity. So one piece of cup, one cup, I mean, it's 2,000. Maybe it's a printed cup. These cups, you print them, you customize them, people use them for gifts and all that. So you sell it for 2,000 a piece. You're part of printing and branding business. So quantity is the amount of how many pieces are you going to sell. So maybe you produce 100 pieces every month and you have customers, you have 100 customers. So your sales are counted by to how many pieces of those cups are you going to sell. So if you're going to sell all of them, if you are able to produce 100 cups or print brand 100 cups and then sell all of them at this cost per piece, so if you times this and this, you're going to get about 200,000 shillings. So that's going to be your total revenue. Okay, that's going to be your total revenue. And then if you're going to, now what would be your cost? So your costs would be, think about any cost that you would incur for you to produce this cups, okay? So maybe there is transport, maybe there is packaging. You have to really put a nice package because they are going straight to the user. Maybe you're gonna use I don't know if it's if you're gonna brand them printing. So think about every cost. So every cost has a price. So maybe transporting them per piece. Okay, we're calculating per piece, and then we're going to calculate. So this is the cost per piece, and then we are going to multiply by the quantity of those cups, the pieces of cups, and then we'll get the total cost. So if you add the cost of transport per piece, packaging and all that, and maybe you get about, 1,000 or 1,300 is your cost. Everything that, that costs you to make that one cup, available to the user. So we take this times quantity. Again, it's the same 100 pieces that you have sold. So you will get about 1,300, 130,000, I think, right? So T shillings. So this is your total cost, okay? This is all that is going to cost you to have these beautiful 100 pieces, cups, okay? Beautiful cups in the hand of your customers, okay? From when you start your business to everything, okay? Your labor, your land, your transport, I don't know, everything that you're using, ink, I don't know if you're using ink, electricity, whatever that you can think of, whatever is going to cost you, okay? So every business has different costs. You have to know your cost, okay? So then we take the difference, 200, the total revenue, and minus this. Then you're going to get 70. So this is what now remains for you as your profit. Okay, so this is your profit. Okay, so I hope this is very clear. So any business, any seller, any producer, their aim is to get to this figure, to realize this figure in a way that it's positive. First is to have a positive figure, and then this figure to be as maximum as possible. Okay. All right. So now, I think just by speaking about these things, I think clearly we are seeing that, I think we'll also look at when we get to profits, we'll see that they're constrained. In as much as every firm wants to get profit, wants to maximize profit, they cannot just do it anyhow. We'll see that we'll see here, and we'll see later in detail that they're being constrained, they're being limited. They can't just wake up and increase price. They can just wake up and increase quantity or just decide to reduce costs. Not really. So they're being constrained by, by price level. Those are the key constraint, but also costs. So if costs are too high to do a certain business, and some of these or most of these costs, they are sometimes out of their control. So there are some costs which might be within their control, but some costs might be out of their control, which might be a burden to the producer. So let's say, maybe transport is not favorable or is not reachable in some of the areas. So you have to maybe rely on your own transport, or maybe issues of electricity. Electricity is not in your control because you have to, you depend on the power that is provided by the company that provides electricity. So if there is a power cut and then you're supposed to, to get some energy to run the factory and things like that, you might not be able. So that increases the cost burden when those costs are heavily on you. So always, once you incur those costs, whether planned or not planned, they can affect the amount of profit that you probably anticipated to gain. So these are always constraining factors to the producer or to the firm, to make them really, not get what they want as far as profit is concerned. Okay. So for us now we want to really now look at cost. Okay, cost is something they can work around, because as we see, it's the biggest constraint, but it's also something that they can work around. So how can they get to work around or to understand their cost? Because this is, like, as I say, it's important part of business, how they are able to maneuver around and manage the cost. That the better they do at this, the better the profits are going to be realized. So how can a company or a firm minimize costs? So for us to understand costs, we have to start with production. Okay, so production is where it all starts. So before we see the goods in the market, you see goods in the shop, we want to see what happened, how did they get here? Okay, so this is how we get to know where it all starts. So what is production? Okay, so we're going to spend some time in this chapter. We're going to be looking at production, what really happens. Okay, and then we are going to look into costs. Okay, so once you have understood, this is going to be a foundation to now go back now to cost. Like, so with every output that is being produced, in the whole process of producing outputs, that means the goods and services, their costs incurred, their costs attached. Okay, so we are going now to cost, and now also try to analyze this in like short period of time. Okay, we call it short run, and then we're going to look at it in the long period of time, which we call long run. We'll understand it later, but this is how our chapter is going to flow. Okay, so production is where, this is what I was just talking about. Okay, so it's maybe some of you, most of you might think, when I ask you what is production, maybe the image that if I ask you, think about production, probably the image that comes in your mind is a factory, machines making goods and stuff like that, right? Or you look at your gadgets, electronics, and think about, okay, where they came from, that is production. Or you think about cars, aeroplanes, maybe, anything that you can think of, maybe a microwave or a refrigerator. So those are the things that, okay, that's production happened to make those. It's more of that, right? Factory, machines. But you're not wrong. But when it comes to economics, we get to be a bit broader, because not everything that is being produced comes from the factory. Okay, so here we mean any process of combining inputs to make outputs. By outputs, meaning goods and services. So any process of combining inputs to make goods and services, that is production. Okay, so what are your inputs? So remember, we discussed about inputs. Inputs are your resources. Okay, so we discussed that there are four main resources: land, labor, capital, and entrepreneurship. But of course, you can have, that's why it tells you, as well as other things, you can have inputs that you really don't know where to place them. They're not directly land, they're not directly in the labor, they're not directly in capital, entrepreneurship, but they're inputs. They're inputs. You need them to combine together to make goods and services. But in one or another, maybe they come from any of this, but you can't really quite, place it. So we just call it inputs. So they fall into, that's why we're using the word input, because input includes the main resources and as well as other things that are part of inputs. Okay. All right. So let me just, if I give you an example, it's like if you produce some, if you're a farmer and you're producing, let's say, beans. So if I ask you, what are your inputs in your production process? So you can think of resources that you know clearly, like you will need a piece of land, fertile land. You will need a farmer, people to help you work in the farm, so laborers. You might need a tractor. So maybe a tractor wheel is capital. But then there are things that you might use and you don't know where they're falling into. Things like fertilizer, okay? So things like seeds. So they're not really land, they're not really labor, they're not capital, they're not entrepreneurship. So where are they? So those other inputs are the ones that I'm talking about. So in any production, you'll find that. Things like electricity. So, you know, electricity is like you need electricity to do things. If it's not there, you might not really get your output. So that is not really land, it's not labor, it's not capital. So it's an input. You need it in your production process, okay? So technology is a very important aspect. So production has to adopt or has to use a certain technology. So again, technology is not just limited to, you know, I think when we talk about technology, we think about digital issues, you know, using machines, robots, and all that, like probably internet, but not necessarily. When it comes to economics, it's just the method that you use to combine inputs. So the cheaper the method to get the same level of output, the better. So if you get a cheaper technology, it's better. So by methods available for combining inputs, let's say you have labor and capital, okay? So if it's cheaper to use just labor, and then you're probably going to produce same level of goods by using more labor, okay? You'll employ more labor, maybe because they're cheap. But if you're in a country or in a place where to employ laborers and pay them salary is too expensive, you better have machines, you better have robots to do the work. So probably that is the easier technology, or it's the cheaper technology, it's the best, most suitable, and it's available. So you use that technology, you use more of capital than labor. That makes sense, okay? Okay, so that's very important. Another thing that is also important in, okay, so what this statement says, so there are different levels of production, okay? By levels of production is basically, you know, the level of output, okay? So let's say you have just started your business, you're producing, you have a farm of 1 acre, okay? With 1 acre, you can produce maybe, you know, 1,000 kilogram of maize, okay? Then, I don't know if that's realistic, but it's just an example, okay? You've just started farming, so 1 acre is 1,000. So this is your level of production. So this, you're using 2 farmers, let's say, in this 1 acre farm, and the land is the size is 1 acre. So increasing levels of production, meaning that this you've just started. So maybe in 1 year, so you have maybe a cup of rotation of harvesting. Every time you harvest, it's per plant, maybe every 6 months, you get your 1,000 kilogram, or maybe every year you get 1,000 kilogram. So after 1 year, so maybe after 1 year, okay, now you have, it depends, okay? But you want to increase your level of production from 1,000 kilograms. So you want to get to 2,000 kilograms. You want to double your produce, okay? Now you're used to farming. Things are doing good. The land is fertile. Things are promising. So you want to increase to this level. So if you want to increase to this level, remember, this is output. So whenever we talk about, level of production, we talk in terms of output, okay? Output is either what you're producing, the goods. And so if this is, your 2 kilograms of maize, that is your output. So for you to get to this level, remember these 2 farmers, what are these? 2 farmers and 1 acre land. These are your inputs, okay? So you mixed 2 farmers, which is labor, right? Plus land, another factor of production. Of course, you had fertilizer, you had water irrigation, probably you had a lot of other inputs. I'm not saying these are the only ones, but these are the ones, they're probably more common here. Maybe you had capital for tractor. So whatever that, I'm just using this as an example, right? So now you are increasing your target. It's your second year or third year in business, and then you're increasing your target. So you want to change your level of production. You want to upgrade, right? So with higher target, you have to consider, how are you going to mix your inputs? Okay, how are you going to mix your inputs? Okay, your inputs, and how much are you going to use to reach the 2000 level. Okay, so for you to make these adjustments of whether I'm going to need maybe 3 farmers and 1 acre, or I'll need to increase the acre and have the same farmers, or mix of both, I'm going to have more farmers and more acres. These adjustments, they depend on the time horizon. By time horizon, meaning that how quick do you want to change, to make these changes? Okay, or how much time do you have to realize this change? Are we together? I will show you a bit more. Okay, so if you want to arrive to 2000 kilogram in 1 year, maybe you might not be able to change everything. You might not be able to change farmers and change the acre of land. It's going to cost you more. Okay, so maybe that might not be realistic. So maybe you might increase just farmers and remain on the same land, but maybe using also some good fertilizer and something like that. Okay, or some seeds. Nowadays there are seeds which are, how do they call it? They're genetically, worked on. The name skips me, but I think you get that, right? They're more, they're lab tested. So they're more, they're designed to produce more. Okay. So for you to make these decisions depends on the time. So if you say, maybe I want to make I want to produce 2000 kilogram in 3 years from now, or in 5 years from now, then that's also a different story. You have enough time to make money, to make profit and invest back in the business. And you can even buy more acres, hire more farmers and reach this target without any pressure. Okay, because you have time. But if you want to do it in the next 6 months, in the next year, that might be different. So for a firm to change its level of production, or when it wants to change for whatever reasons, it will have to adjust the amounts of these inputs, okay, by looking at the time horizon. So what is the time horizon? As I said, time horizon is divided into 2. There's short run and long run. Okay, so we call it short run and long run decisions. So long run is a time horizon long enough for a firm to vary all of its inputs. Okay, and then short run, this is a time horizon during which at least one of the firm's inputs cannot be varied. Okay, so I will give you another example, but just back to this that you understand. So if this person started with 2 farmers and 1 acre, and then he was able to produce 1000 kilogram per year, if this person wants to increase the level of production to 2000 kilogram in 5 years' time, are we together? In 5 years' time, he wants to start producing 2000 kilogram. By the time the 5 years come, he will be able to do anyhow. He can employ different farmers. He can acquire more pieces of land, because it's a long enough time to adjust both inputs. Okay. But at the same time, if this same farmer Okay, if this same farmer wants to produce 2,000 kilograms in the next 6 months, okay, in the next 6 months, you cannot really change quickly all of these factors. You can change fertilizer, you can have more fertilizer or different fertilizer. It's easy to buy, maybe tractor, maybe, I don't know, water for irrigation, but the things that could limit you, okay? Farmers also, you might get people to hire, more people to hire. But when it comes to acre of land, your acre of land, probably you already paid rent for it for maybe a year or 2 years, okay? So it's at the beginning of the year, maybe you already paid for it. So if you have to increase the level of production from this to this by increasing the size of the land, in 6 months' time, you might not be able to do so, right? Because maybe you might not have the money to rent another space. Okay, maybe there could be already somebody else over there in the next space, so you might need time to move that person out. Maybe you also don't have enough money to make such a decision within 6 months and get the money to buy that plot of land. So 6 months is a very short time for you to make decisions to increase this production and change all inputs, especially the input of land. Are we together? So this is what it means. So short run is that period of time that is, you cannot vary or you cannot change all inputs to meet that target of output. At least one of the firm's inputs cannot be variable. That means it is fixed. So this is a situation where you are stranded. You want to grow, you want to increase production, you want to increase your output, but you can't change all of your factors of production. You cannot change all your inputs. At least one limits you. It's fixed. Okay. I hope that is clear. And then in the long run is a long period of time you can vary all inputs. So for those inputs, we say there are many inputs, okay? There is labor, there is land, capital, entrepreneur, and other inputs also, okay? Other inputs. So inputs can be so many that you can think of, okay? Raw materials, electricity, maybe water, I don't know, water bills, whatever. So variable inputs is an input whose usage can change as the level of output change. So due to your changes, whether in the long run or short, so here we're talking about short run, okay? Long run, you can change all inputs. It's a time long enough for you to change any of this into any amount you want because you have that time, you have that resource, you have the resources to change. So if you're able, but in the short run, there are some inputs you will change, some inputs will be fixed. So as per our farmers' examples, variable input are input whose usage can change. So all inputs that you're able to change. So this person was able to change the number of farmers, could increase over the next 6 months. Land, not really. Capital, maybe you can have because you just getting a tractor, hiring and return. Electricity, raw material. So all these probably is easy to change. So we call this variable. But this one, fixed input, is an input whose quantity must remain constant regardless of how much output is produced. So the land is not possible to change within the next 6 months. So it will remain fixed. That's why we put a cross here. This land, same acre of land, you have to use it at least for a year because you already paid for it. You already bought it. You already paid for it. Or you already rent it out. So it's hard to get another space quickly. Okay. So this is a quantity of input that you already incurred and you can't change. So it must remain constant. Okay. I hope that is clear. So I want to give you another example. Okay. I have even some pictures here to make it, visual and maybe, understand much easier. So let's look at this. this is think about it. Think about a fashion business. This is very common, in our lives. We have these designer stores, fashion, clothing, tailor business, where people are making some local fabrics and make different designs. I think all of us have been some clients at one point or another. So let's think about the business model or the business way of a person who is in this industry. So let's say this is how it started. So for someone who is in this business, this is what they would need, right? This is their machine, the sewing machine. And then they will definitely need laborer, a tailor, okay, just one. And then this is the output, okay? So let's assume these are the kind of clothes that they produce. So what would be, so you can also think of other inputs. This was just an example. Again, you need a workspace. You can see these ladies in a space, these clothes are in the space. So there's an office where all these things are, which rent is already paid for. So that is that is land. You can think of it as land or as capital in terms of building the rent. So that, and other inputs, like you see this here, there are some materials which they are using. So probably they need to buy these things, threads, a lot of things, inputs, other inputs that they'll need electricity here. They are paying bills for electricity to use for the business and other users. So it's a lot of other inputs that we can think of to make this business happening. Okay, but these are just few because I want to make a point here. Okay, so we said production is a process of combining inputs, all the inputs we have talked about, to produce output. Okay, so this is your total output, which is measured by the number of clothes produced for customers. So if this lady is probably also the owner of the business, she started her business one room with her machine and herself. She's very good. She can design, cut clothes. There are so many processes, right? It's not just putting the cloth and start sewing. So you have to know, people will come to you with their different custom designed, or you have to design for them and then you have to make it, right? Then there's a process of cutting the clothes into pieces. It's just a lot of things. So at the beginning, she's the only one, so she does everything. So she cannot take so many orders because she has to do all that. So let's say in a month, okay, in a month, she can make 50 clothes. So if it's maybe dresses, just 50, right? 50 dresses or 50 pieces of clothes, okay, per month. So this means if it's one customer per cloth, then 50 customers. She can only have 50 customers in a month. So that means in a day, she produces about a little bit more than two. Like some days she produces 2 dresses and some days 1, but mostly at least 2 dresses, I think, if you divide by 30, right? Okay, which is a bit much, I think. So, but this is just for the purpose of learning. So from how she started, this is how her business is laid out. So with a demand of 50 clothes, she can manage everything. Okay. Then now, how is the business going? So let's see that, people love her designs. Her name is spreading. When people see someone's wearing her clothes, they ask people, where do you get it from? I get this from so-and-so. So now a friend told a friend she's starting to get more orders. So in the next 3 to 6 months of being in business, her demand has increased. People are looking for more, people are ordering for more clothes, okay? So now her order has increased. Now she has 80 customers waiting, 80 clothes to produce, for a month. So that is like a sudden change. Now, this lady is just 3 months in the business. She can't really afford to get, for her to be quick to make 80 clothes per month, you would think of many ways. Okay, there are many ways she can do that. She can increase the machine, she can increase laborers and stuff. and meet the demand? Are we together? Because, people are demanding more. But is that possible? Well, that might be a limiting factor because she's just starting with the business. She has bills to pay. She has to pay rent. She has to pay everything. She has to buy materials. So it's not very easy to buy like a new machine. Okay, to buy a new machine and have it and maybe have another person, working on it right away. That might be not affordable in the short period of time. But how about her to add another person? So now, because before in the beginning, she would do everything. She would cut, she would design, and then she would have to, to sew. But now she can say, so that I can save time, so that I can meet this 80 clothes demand, let me get an assistant, okay? I'm going to get an assistant who will be doing all the cutting, okay? And maybe I will be just, the cutting and also maybe dealing with customers, okay? Customers and delivery, things like that, okay? So I am just going to be focused on the design and the sewing, all right? So she has an assistant now. So what she would do for 6 hours now is not, so she gets time to specialize and gets another person who can also specialize. So instead of attending to every customer who comes in, she can focus on the work and only maybe this one can help whenever there's a customer, whenever there's this, whenever there's that. So, but the machine is still one because it's too costly to change it, okay? So at the end of the day, okay, we have them being able to meet the demand. They will be able to produce 80 clothes and get their clients satisfied. So output level has increased in the next, 3 months after starting the business. Inputs, not all have changed. Okay, she didn't go and change everything altogether because the time frame, okay, this is where now we're talking about the short run. This is the short run. So in the short run, you don't have enough money and maybe time to change everything, to meet that demand or to meet that output level. All right, this one, the change in level of production. Okay, so you can only change some inputs, and some inputs you have to have them fixed. Okay, that is the story here. So you have one fixed input, it's still the same, but this is varied. So this is a variable input. This is a fixed input. Okay, this is your fixed input. This is your variable input. And now you have more output. Okay, your output quantity, we call it Q quantity or output, it's more. This is your level of production is higher. Okay, so this is for a short run. Remember, this is for a short period of, so for a short period of time, you will always have fixed input, even if just one, but there must be a fixed input because you can't change suddenly, okay? Change everything suddenly to meet that need of output, okay? And then other variables, you are able to change them, okay? So another way you can think is that, remember, this lady is having, she's rented a building. She's already paid rent for it for 6 months, 12 months. So if she wants to get a bigger space, it might be difficult, because of the increase in everything. So that's another way to think of it. So maybe the land factor would also be fixed in this case because she can't just move out. She already paid rent for 12 months. So it's going to be the same. Okay. So even if she wants to expand, but she can just do it in 3 months. She'll remember, oh, I already paid the landlord 6 months. So I can't go and look for a newer place, nicer place because I'm getting more customers. No. She'll have to wait at least after 6 months, after 1 month, after 1 year, that's when she can move to another building that is bigger and spacious. Okay. So what happens if this lady has been in a business, okay? She's been in a business long enough, she stayed, She had a laborer, increased and met this demand and went on year 1, year 2. Now she's thinking of expanding her output, okay? Her output demand is increasing, and then now she's planning to meet that increased demand in the next 3 to 5 years. She now her name is growing, her brand is known, people are coming to her, so many, she's been increasing here and there, still fixed on some things. But now she's thinking of growing to get to this target where she can produce this level of output, 300 to 500 quotes per month. That's huge. That is big, right? So this is a long, 3 to 5 years is a long time enough, to make plans whereby she can increase everything she wants, okay? If it's machines, she can have as many sewing machines as possible. You see, up to there, it's just a lot of sewing machines. If it's laborers, she can have a whole bunch of people who are good and, can work a lot of hours and things like that. If it's space, as you see, this now is in probably these are also stores. These are indoors and outdoors. So she has a huge space that she constantly does produce. Okay, so for her to meet the total output of 300 to 500, because she has enough time, 3 to 5 years is enough to change. So she can change any levels of her inputs. Okay, so all inputs can change. There is nothing that is going to be fixed. So here, all inputs are variable. So this is what we call long run, long period of time. Okay, long period of time, long run. So this is a time long enough for a firm to vary all of its inputs. Are we together? If you have understood this, remember, this is going to be the foundation. When we get ahead, when I say long run, I say short run, you should understand what changes, what does not change. When we say fixed or variable, you should know where does that happen, in the short run or in the long run. Okay? All right, so I hope this example has really cemented what I was trying to say. If you combine this with that of a farmer, it really helps you to understand. So this is what happens in production, okay, as far as production of goods and services and how decisions happen to adjust levels of output. So remember, you don't just get to a shop. If you go to a shop today, some of you would like to go to the shop and you don't find a new stock of that commodity and you're like, will it be there tomorrow? As if they are working in magic. So there are so many factors. It depends, okay? So if they have run out, it's going to take time. Let's say you want to get well, I can think of anything, but you know what I mean, right? So if it's something that is easy to ship and bring it to the shop, probably you'll get it sooner. But if it's something that requires a lot of things, then you might, have to wait longer. So every decision in production, it's to adjust levels of output to meet the demand will be constrained depending on the time. So because of that, they're also looking at the factors. What factors are going to be fixed? What factors are variable if it's a short term, because short term is usually not enough. Now, if I ask you what is a short term, short run, what is a short run period? How long is it? So it depends, okay? For someone, short run can be 3 months, okay? That is their short run. For someone else, short run is 6 months. For somebody else, 1 year. And for someone else, short run is 3 years. And for another person, short run is 5 years, okay? So if you think of, let's say you are in Aarti University, so, the VC, Vice Chancellor, wants to increase courses, okay? Wants to offer, let's say, some degree program courses, master program courses, and maybe some PhD courses. So that means more students, that's more production, right? But if they have no buildings, Okay, they have no buildings or they have no teachers. So that means they're being constrained. They want to increase the level, but they're being constrained. And you can think of course, other factors that they will need to have as inputs. I'm just speaking, those are the main ones, right? So that means depending on how long they can get those resources. So let's say if they don't have buildings, of course, they can do classes, let's say evening classes and maybe, but if even that is still, there is no space. There's no space for even evening classes. So that means they'll have to build. So that means they'll have to acquire land and then they have to build. So unless otherwise, they are going to operate on fixed resources. So they might start the courses and do evening programs. That means they take more students. So level of production has increased. And the teachers, of course, more teachers will be hired. But as far as increasing the buildings, it's going to be fixed. They're going to be doing everything on a fixed property because it takes at least probably 5 years to acquire land and build classes to the finish. Okay. So that is a short run for them. 5 years is a short run for our university to have, to be able to get a point where they can adjust. They have buildings, they have enough teachers, they have everything can be varied. Okay. Until then, they have one fixed factor, which is the buildings. Okay. So that could be a different story to another person. Okay. Let's say if this tailor business, this tailor business could take maybe 2 years or 3 years to get to this point where she has a better space, she has more machines, she has more workers. So for this person to get to the long run, it only took her 2 to 3 years because her resources are not so much, large scale. So she's at a level where she's varied all her inputs. She can make decisions to vary all her inputs within 2 or 3 years. That's fine. Whereas for our university, it took them 5 years. I hope you get what I mean. And for another person to make a product reach the market anytime, like there's some companies that are so big. Think about Coca-Cola. If Coca-Cola wants to produce or to introduce a new product or to increase level of production, probably they won't take as much time because they already have vast amount of resources that they just need to change uses to adjust them accordingly. So if it's land, probably they have plenty of land. If it's capital, they probably have enough or a lot of capital or a lot of money to buy that capital, like tomorrow or in the next week. If it's a research team to test that product, they can hire them, they can afford them. So for a big, huge company, they've already operated, it's like they make long run decisions already because they already have the resources. I hope this makes sense. Okay. So it's not about, when you say long run, how many years or how many months, it really depends with where the company is. But just know, if you want to make quick decisions, if you want to make considerable decisions or changes on your output level, okay, but you cannot adjust all of your factors of income at that particular time or in that particular period of time, that whereby at least one factor has to be fixed, then you are in the short run. Okay. And then long run is where you want to increase your level of production. It's not about just increase, even to reduce. Okay. So a company can decide to just wake up and stop producing, and all factors go to zero. You can fire all workers, you can close all business and everything. So you have changed everything to zero all of a sudden. But for short run, you can't just do that. Okay. Short run, if I want to close my business, and then I've already paid rent for next 6 months. So that's a fixed, that's a fixed cost already incurred. So it's still going to be counted whether the business is operating or not. So I still have I've changed other things. I've stopped paid for electricity. I've fired people, you know, I've sold out the fabrics and everything, but the rent is already paid. It's already outstanding. I hope you understand what I'm trying to say. Okay. So whether you want to increase the level of production or output, or you want to decrease it, how are you going to adjust your input factors to? So if you have understood that, then I think that will be a great way for us to really move forward, and it lays a foundation for that. Okay. So this is what I was actually telling you. Okay. So now let's get to now the production and the calculations that happen in the process of production. Okay. So this is just an example. Okay. Now you bring, so this is now, we want to see how actually short run, we're looking at the short run, right? So we are starting with short run and then we're going into long run. So this is how production in the short run happens. So you have capital. So this is an example of a car wash business. This is from the textbook, okay? This is from the textbook. So back to the textbook, we are looking at this example that we are given. So this is a car wash business, the car wash business where you have automated lines. So in other words, it's like, I don't know if you've seen the, I don't know if we have some in Tanzania, but I've seen them in other countries where, you know, you have, or maybe you have seen it also somewhere else, maybe in movies or something, like a car just gets into a line and then as it moves, it gets washed automatically and then it gets dried. Like by the time it goes out at the end of the line, it's sparkling clean. Okay. It's just so beautiful. So that one, that is what it means. So this business has managed to invest in getting that automated line where a car gets in and just get, you know, and then of course laborer, and then there's this is total output, the amount of cars washed. So the labor now does the washing and everything. Of course, it doesn't clean the inside. It just does wash the outside, right? But it does wash very thorough, like very well. So now this business has invested in the automated line, which is the capital, and then it recruits labor. So at the first time, we see that one amount of capital, just have an automated line, but no labor. So obviously you can't have anyone to operate it. So you are not going to get any output, no car washed, because there's nobody to operate. So you hire one person, okay? You hire the first person and then they do operate. So cars start coming in for business, they do run it. So from morning to evening, they clean. This one person cleans 30 cars, okay? So this is the amount of car wash per day. So you want to increase your production, okay? You want to increase your level of output. And then the best way to do it, you can't really afford to increase one line. I mean, another line, it costs you a fortune to have that automated line, okay? So you would need a whole huge of capital, maybe take a big loan from the bank or something to install that line, another line for the car to operate. So you can't do it in a short time, okay? So this is a short run. If you see something is fixed like this, that means, you know, maybe this is like, it's not easy to like just change suddenly. So the only thing you can change to increase production is labor. So they're going to add additional labor. So by 2 people, now you have more specialization. Remember that, right? So with more specialization, remember your output has increased from washing 30 cars by one person. Now 2 people are washing 90 cars. That's amazing, right? Then you want to have more output. So you hire another person. Then, you know, it increases. So you see, as the more you're increasing your laborers, look at this trend, more output. So this is what is called your total product. This is your total output, okay? So if you're to draw this, your x-axis be the number of the variable factor, Capital is on the other hand, is not here, but if you were to draw, that would be capital is not changing, right? So this is our variable factor, and then so laborers that you are hiring, and this is the total amount of output. So at every level 1, you got 30, 90. So if you draw, you get this curve. So it's very important, and I'm going to ask you, at some point, I think I've been telling you, whenever you see tables, you see figures, you need to know the trend. So be very careful to notice how is the trend, okay? So if you see this is increasing, right? It's increasing throughout. But there's something here. You see, there is an introduction of marginal returns. Do you remember how we talked about marginal returns, right? Marginal returns is, we want to know, in other words, also is marginal product. So we want to know, the more you increase labor, how much does output increase? Okay, so marginal product is, change in total product as a result of change in labor. Okay, so I want to know how much output is increasing or is changing. Is changing, actually, not increasing. How much output changes as a result of adding 1 more unit of labor. Okay, so again, you do that. 30 minus 0, divide by 1, you get 30. 30, you get 60. So just adding, if you see this, just by adding 1 person, output increased by 30 units. By increasing the second person, 1 more person, 60 units, right? So you do that, you do that, you do that, you do that. Make sure you get this, and then you draw a curve here to show marginal product for this, to see what it looks like. Okay, so these are very important terms to know. What is total product? Marginal product, that's what I was saying. Then there is something increase. This is a trend now. How does marginal product trend is? So you'll find that there is an increasing, and then there is decreasing, okay? Whereby the decreasing is what gives rise to law of diminishing marginal returns, okay? So this is what it looks like. So the total output, as we've seen, this is the total output, is the total product, okay? So we saw that the total product was increasing, but if there is some data, sometimes you might be given information where, the firm hires labor, a lot of labor. So the more they add labor, this is quantity of input. It could be capital, it could be labor, whichever that is changing. So you find that as a company hires more laborers, total output will first increase, okay? And then it will start to increase, but at decreasing rate, and then it start falling, okay? So this is our marginal product, okay? So this is like the corresponding, and this is the corresponding average product. Average product is, we want to know, is the total product divided by per unit, okay? It's here, actually, per unit of labor. So I want to know, it's like if you have 3 laborers here. This is an example, okay? At this point, you had 3 laborers. They were producing how much? 130. So if you want to know on average, how much does each laborer produce? So you divide total product, divide by labor. You get 130 over 30. That is what each one is producing. But if you want to know additional, what is the third one producing? The third one or the second one. So you find marginal product from here to here. 3 minus 2 and 130 minus 90. So you get 1 here. So the third person produces how many output, washes how many cars? You just take 130 minus 90. Okay, that will give you, I think, about 40. So you see, so average product is not the same as marginal product. All right. So these are very important terminologies to know, and these trends are very important. You should know every region. So marginal product, it takes a trend, it takes a certain trend. So you have to know is where is marginal product? Marginal product can maybe start from here, it's declining, or it can start by increasing and then decreasing. So usually this is how it goes. When total product is increasing, marginal product will start by, the more you are hiring additional labor, you will get more from the additional labor, right? But as you keep hiring and hiring, it becomes less gain for every additional labor, if that makes sense. It's like you only have one machine and then you have one labor. One labor can operate on one machine. If you have just one machine but two laborers can use one machine but maybe specialize on other things, so they'll still bring more production. But if you have 3, 4, 5 laborers on the same one machine, it starts to become chaotic. Some laborers will be idle, will be without anything, right? So they will not really add to production. So that's why you will start having this declining, even up to negative. Okay. I hope that is very clear. So you have to know what it means by diminishing marginal product returns, negative marginal returns increasing. You have to know that. All right. So now let's look at the costs. Okay. So costs here, if you have understood everything here that we are doing, it's just now a strong foundation, because from now onwards, my dear good people, we are now going to all the way, even the topics ahead. It's all about costs, revenue, profits. Costs, revenue, profits. So you have to understand about this total product, marginal product, average product. It's like the foundation, because it really explains how inputs are combined to produce output. Okay. So costs here, before we just get into costs, I just want us to know first, in economics, we look at cost, a different kind of costs. Okay. If we ask an accountant to report on costs, an accountant will just ask you, how much do you spend on this? How much did you pay on this? They will just collect the recorded payments, the actual payments. Do you remember what we called that? What is that called? Every payment that is paid directly, that is incurred directly. So if you go to the shop and you ask, what is the price of soda, and they tell you it's 1,002 shillings, the amount you actually pay directly, that is the cost, okay, you incur. So that's a direct cost. Direct cost, I think we talked about it, is the explicit cost, okay? So that is an explicit cost. So, but then when it comes in economics, there are so many other costs. So there are costs that there's a sunk cost, and then there's implicit cost. So a sunk cost is a cost that has been paid or must be paid regardless of any future action being considered. Okay, so sometimes we mix. You might include sunk cost in the other cost, but usually it's not. Because you basically incur it directly as an explicit cost, but it's not going to be included in the process, whether it's production or anything. Okay. So for instance, is that, people spend a lot of money in research. So whenever you see a product is being produced, there's a research that is done, there have been tests. That's when the product comes into market. Okay. So think of even if it's a construction materials, cement or anything. So they have to test it. They have to research what materials are good, the raw materials, however, whatever, what weather and things like that. A lot of things to see if it's good enough to go to the market and also arrive so that it can sell to the target market. And, you have to know that it's really needed, demanded at that price. Okay. So most times, you can be right or wrong about your research, okay, about that commodity. So let's say you spend 10 million on the search for a particular kind of building material, okay, on a certain type of building material, so that you want to introduce it because it's very weather friendly. It's going to transform the entire industry, as far as green economy is concerned and things like that. So you spend maybe $10 million in research to test this, okay? And if this research is successful, your production and your sales, given the market is huge, you might make $10 billion, okay? $10 billion from this, all right? So upon your research, you realize that your conclusion, your conclusion is that during rainy season, okay, during rainy season, this building material is so good, everything is working, but it can't survive in rainy seasons, okay? So therefore, it's not good for business, okay, for the market you wanted, but only for building in buildings that are never exposed to rain, okay? So it's only going to sell for any construction of the buildings that are never exposed to rain, okay? So what it means, and maybe that's, buildings that are not exposed to rain are not so much. So if you're going to get customers, you might make maybe about $1 million, okay? $1 million instead of $10 billion, okay? Because this is a small market. It's a very small market. So what is sunk cost? Okay. It's a cost that has been paid. So you already incurred this money, okay? You had researchers or you promised to pay them. You already incurred this process of doing research, okay? But the future action, the future or the conclusion is that whatever you have come up with did not really pay off, because the market that is suitable for this is only for this building. So where the market, if you're going to sell anything out of this, if you ever produce, it's going to be this amount of money, okay? So in other words, are you ever going to recover the 10 million? Even if you want, whether you sell it here or you sell to this market or don't sell, this is already incurred. So there's no way you can recover this. Okay, and whether you pursue any of these decisions, like going to provide to this market or not at all, you still have to pay this money. So you've already incurred this money. So this is what is called sunk cost. I hope that is very clear. Okay. So it does not really matter what you're going forward with. But if you say, I will go ahead and, make the building materials and meet this market, what will determine whether you're going to sell for $1 million or not is the cost, the actual cost of producing the building materials that will sustain under rain. So whatever cost you're going to incur, maybe it's going to cost you $500, and then you're going to sell for $1 million. Then maybe I'm going to do it. So these are the ones that will predict. But this one, you have already incurred. It's gone. Okay? So explicit and implicit costs, again, we covered this very well. If you have no background on this, please go to the first chapter. We talked about explicit and implicit costs, but for the sake of production, how firms do it, how we calculate it, is the same concept as opportunity cost, okay? So in the opportunity cost there in the first chapter, we're looking more about how a consumer, right? A consumer makes decision and, forego, like, when we gave an example, as you as a student, your decision to come to university and study 4 years, you are going to sacrifice, your time that you could probably, spend it doing something else, maybe work or travel the world or be anything. Suppose you had other options to to do apart from coming to school. So what is that you are sacrificing? So that is, we did that, and then we went on to calculate what is explicit cost, the school fee you're paying. Your parents could invest that money to something else, a business, something, but they're paying for your school fee. So we discussed about that and how to calculate that. But then now we're coming to the business firms. So firms, in as much as they incur costs, they want to minimize them. So they also, when we calculate costs for firms, we don't just take the amount that they pay directly, like wages, salaries. When I ask you what are the costs that a firm, a business incurs, automatically you will tell me the rent they pay, the wages, the cost of raw materials, all that. So that is good, but that is an accounting cost, right? That is just an accounting cost. But we need to know the economic cost. The economic cost includes all of them. The direct cost, which is explicit cost, and I mean the direct cost, which is the explicit cost, and the indirect cost, which is the implicit cost. So this is an example. For instance, you're opening a fast food restaurant in the build. So you have you want to do a business. You want to open a restaurant in the building that your family owns. So it's your family building. It's like your own building. Okay, you're not going to rent space somewhere. So no stress about that. So you are free to pay you're not paying any rent because it belongs to you, to your family. Then you have your own capital. Okay, you have been saving all your life. Probably you have this amount of 10 million. So it's yours again. You have not gone to the bank as most businesses start. You have not borrowed anywhere. You've not sold out anything. You have this money from your savings. It's yours. And also, you have not hired anybody. You know how to cook, you know how to do everything. So you're managing the restaurant by yourself. Okay. So what would be your explicit cost? What would be your implicit cost? Okay. So think about that. What would be your implicit cost? What would be your explicit cost? So this is just a way to think about it. So these are just categories, okay, to help us. So depending on the scenarios or the business, okay. So is there any rent paid out? So if you are paying rent, if it wasn't your own building and you had to pay, let's say maybe 500,000 per month, 100,000 per month, that would be explicit cost, okay. But since you're not paying, not really, you're not paying money directly, so there's no rent paid out, it's free. However, remember, there is an implicit cost because that space that you own or your family owns, they could rent it out to another person and open it up for business. So somebody else could be renting. They could create frames, they could make business there, or they could make it into a house. People could be living and pay rent. So you are foregoing, okay? So here there's a rent foregone, okay? We call it foregoing rent or rent foregone that you could have received, but you're not, because you are so this is the amount of rent you could have been collecting. So you're losing out. You're missing out that rent because you're running a business, okay? Whereas if you paid out by yourself, it wasn't your building, you would have to pay for that. How about interest? Interest is money on savings, right? So this is usually on the capital. So because this money, you didn't get it from a bank, so you're not paying any interest. If you got this as this money, this capital money from the bank by loan, you would have to be paying interest money. Yeah, you'll be paying interest rate. So that would be your direct cost. Every month you're paying back the loan, right? With interest. But then because here it's not, it's your money. However, because this money, you had this money, right? If this money was in the bank, you would be receiving some interest. Let's say you are saving this money in some bank, let's say CRDB, and then they give you 5% for your savings. So 5% of this is how much? This is 10 million, right? So 5% is about what am I doing? 1 million is about 500,000, right? So if this money was sitting in a bank, if you save this money, you'll be getting, I think, 500,000 per year, or I guess maybe 500 per year. Whereas if you invested this money, you could get even much more interest, right? Returns. So this is interest forgone. So you are missing out interest because you chose to take your money and invest in business. So, okay, I hope we're together. So this is interest forgone. How about salaries? So salaries depends on who are you hiring. So let's say you decided to hire a receptionist, right? You decided to hire a receptionist or a server. We call them servers, right? Waiter. So you decided to hire a waiter. And then you are managing a waiter and a cook. So you have two people, one who cooks and another who waits. So there are two employees, but you are still managing the restaurant by yourself. So salaries, because you're paying out money to waiter and cook on monthly basis, wages. So this will be wages and salary, wages or salary that you pay directly. I assume you pay them directly every month to the waiter and cook. But how about yourself? So maybe yourself, because you're saying I'm managing the restaurant myself and I'm not paying myself. That is not correct. You are still, there's a salary, forgone salary that you should have. By you spending your time sacrificing to your business, you could be working somewhere else. Okay, you could be working somewhere else. You could be doing something else that could make you money, or you could use your time somewhere else. So if you're not, being paid in your business and you're saying, I'm just managing myself. Actually, most entrepreneurs, when they start their business, because they don't really make enough money, they don't really go ahead and pay themselves. So they might count it as zero, but it's not really, because they invest their work, their talents, their creativity, and their time. That should have, which if they worked in another company, they could be getting some money for that. So we have to calculate that. So we call that is a forgone salary for manager, okay, for a manager. All right. So any other input costs. So if there are input costs, let's say there is, this is a restaurant. So think of any input costs, like maybe electricity, whatever they use to cook, whatever flour, whatever those cooking ingredients, right? So all those they're explicit costs because they are being paid directly. So they'll be here, right? They'll be here, not here. How about time? So time, again, you may not incur here, but time, as I said, if your time as a manager. So this actually can come here, the time that you pay you. So salaries, the ones you pay directly, and then time can be this factor where you pay for your time, okay? And any other thing that you can think of, then you kind of see if there is anything that is a component of doing business, is a cost. You can see now, should it be here or here, okay? So you can think of any of that, and then we see how best to allocate that. So I hope when I talk about implicit cost and explicit cost as far as the business is concerned, you should be able to know and calculate it. Okay, so I hope that is clear. So, well, I think you can think of anything else there, right? Okay, so now, since we have, now let's go to now, so costs. So whenever we talk about costs now, remember here it's explicit and implicit cost. Okay, so let's start now. Remember in the first part we said we're going to look at production, we're going to look at costs. So for costs, you're going to look at short-run costs and then long-run costs. Okay, so we are going to start with short-run. So by now, when I say short-run, you remember. Short-run cost is whereby you have fixed input and variable input. Okay, you want to know how much do they cost and how do they affect the entire structure of production and things like that. Okay, so these are different types when you want to measure short-run costs. So these are the different types of costs. Okay, so we said we have fixed cost, variable cost, total fixed cost, total variable cost. So they're very easy. Okay, they're very easy, and we could okay, I don't know what's happening here. Okay, so I'm not sure. Let me see. Okay, so we have, so here, this is an example now. We are continuing with our example of, the car wash business, okay? So this is the output. This is the amount of car washed per day. And then we have capital, the automated line. These are inputs, right? Inputs. There are two inputs, capital and labor, that are used to produce output, which is the amount of car washed per day. Okay, so we start. So remember, this is the cost of capital. Okay, it's like think about it as a rent. Let's say a rent. It could be, this is calculated from the annual, So if this person pays the cost of installing the automated line, you can think about it, or think about, the rent you pay for your house. So if you pay a lump sum in 12 months, you pay a rent for your house. If I ask you what is the rent per month, you just divide by 12, right? If I ask you what is your rent per day, you divide it by 30, right? So in other ways, this is what it is. So this is the capital cost. This is like the rent. This is the rent for the rental price per day. So we have just divided it to see per day how that would be. And then the the cost of labor, which is wage, is also $120 per person, per labor, okay, per one labor, the wage. So it's $120, okay? So at first, there is no output because there's no labor. So what is going to be the total fixed cost? Remember, total fixed cost is the costs of fixed inputs. Okay, is the total of cost of fixed inputs. So this one, what is our fixed factor? To know fixed factor, just look which one is fixed here. It's capital. So we are told the cost of capital is 150. So it's capital is 1. Total fixed capital is the cost of capital. So it's $150. Okay. What is the total variable cost? Total variable cost is the cost of your variable factor. What is our variable factor here is labor, okay? But it's 0. So 0 times any number is going to be 0. What is total cost? Total cost is the sum of total fixed cost and total variable cost, okay? So it's the sum of total fixed cost and total variable cost, okay? So you simply add Roman column 4 and column 5, okay? So you're going to get 115, all right? What is your marginal cost? Remember, marginal is the addition. So we want to know this is the change. Remember, this is how much output changes. I mean, cost changes, how much cost changes as you change output, okay? How much of your, but then it's not on one item, okay? It's going to be somewhere in between, okay? It's not going to be here. We have to, it's a change. So you want to know a change in total cost as you change quantity. So at this point, you leave it until you get to, supposed to be somewhere in the middle, right? It's a change. It's going to be here, okay? AFC is average fixed cost. Okay, so what does it mean? We want to know fixed cost per unit, per 1 unit of output. Like, to produce 1 output requires how much fixed cost, in other words. So you have to take total fixed cost divide by output, okay? Average variable cost also is the variable cost per unit. So you have to take total variable cost, which is from here, you divide by your output, okay? Average total cost, remember, is this is the average, it's the total cost per unit, okay? So you take this over output, okay? I think that has made it very easy. So for marginal cost here, average fixed cost, you take, you find 4, column 4 over 1. Average variable cost is where's column 5 over 1. And this one, and the last one, total cost is column 6 over 1. So I want you to go ahead and populate this, okay? And populate this and see how it would look like, okay? How it would look like for the entire thing. All right, so because 1, 1 is 0, so at this point, you know, all these divide bys, it's going to be, so now let's, when it's 1, this now brings a good story, right? So when total fixed cost is, remember, does not change. So to make your work even easier, you might start with just filling one up to the end. So that you feel this all the way, because it's not changing. It's not gonna, we're not gonna alter it. Then total variable cost, you take 120 times 1. 120 is the cost of labor. And then 120 times 3 times 2, 240. And then you go all the way. Okay. And then total cost. Total cost, you just add this. So 270. And then you keep on adding. Then marginal cost. Marginal cost is, so now remember, marginal cost change in total cost. Total cost changed from 150 to 270. So we want to see the change of this as a result of one additional increase. I mean, as a result of a change in output. So from one point to the other, so 0 to 30. Okay, so you have changed input from 0 to 30. We want to know how much of cost, the change in cost. So you take 270 minus 150, and then I think you're gonna get 120 over 30. Okay, and then you get that gives you 4. Okay, so your marginal cost is 4. So you do the same all the way. Average fixed cost, here you find 4. Column 4 is 150. 150 divided by 30, right? That is going to be 50. Okay. Then total variable cost is 120 divided by 30. I think you are, no, it's supposed to be 5, right? It's 5. 120 divided by 30 is going to be 4. And average total cost, you take total cost divided by that. It's going to be 9, is it? Okay, so you go on and fill this whole table. So this is something I would love for us to do in class as well. And over the assignments, you have a couple of this to practice, to work on, and also you can test yourself at the end of the textbook, questions for practice. So yeah, let's just make sure we work on this so that we know how to calculate and fill out these tables and just understand. So the most important thing after this table is full is now to understand the trending. Okay, that's very important. We didn't just do it for nothing. We want to see the trend. So you can see here, for instance, total output increases. This remains constant. It tells you something. It tells you story. Labor increase. So if you see something like this, you know this is short run because capital is fixed. Labor is changing, is a variable input. Total fixed cost, it's fixed, it's short run. So we need to see this is probably increasing or decreasing. So the next thing that I want you to do is to draw these things, okay? To draw these curves. So if we draw the cost curves, we're going to have something like this. So here, our x-axis, remember, is now different from the product. Here we have outputs and costs, okay? The dollar value, the currency value of via versus the output, okay? So you basically bring this to the table. So as you see, total fixed cost, it was the same at 0, it's 150, 30, 150, 150, okay? And then total variable cost, total cost. So just draw and see what is the trend like. Okay, so you see these are parallel. It tells you something. I want you to tell me why. Okay, why are these parallel? And then when we go on to draw, this is marginal cost, average total cost, and average variable cost. Okay, so these are, as you see, if you saw from the table, we have much smaller values because these are per unit. From marginal cost, average, all these you're looking at, you want to know an increment per 1 unit, you know, per 1 unit, or per an unit increase. For every unit that increases, what is the cost of that? We want to know on average, what is the average cost? Okay, what is the fixed cost per output? So as you see, look at this. While the output is, the x-axis has the same measure, the y-axis has very smaller values. So we cannot combine them. Otherwise, they will be somewhere here. You won't be able to see them if you mix with this because the scaling is different. So that's why we have them on a different scale. So because it's a different scale, we're able to see them clearly. So here it's just from 0 to 10 because it's per unit of output. So the trend is different. So I want you to know, how does marginal cost curve, as you can see, it goes down, then it increases. It's like a V-shaped or U-shaped, right? And then there's this one, ATC. It just starts, like, goes down, and then something like that. Then at the end, it starts to increase a little, then it stops. The same as average. So you need to know why are they like this? What does it mean? Okay. So that is for the short run. As you see, the short run, you will always have some fixed costs involved. So when you go in the long run, there are no fixed inputs. Okay, there is no fixed, all factors, there's no fixed inputs, therefore there are no fixed costs. You can adjust all inputs. That means they are variable. All factors are variables. Okay, so here is the thing. Okay, so how now does the firm produce at this point? How does it choose the level of output to produce? So because it has so many alternatives to meet, to produce a certain output, in the long run, since it can choose, it can vary anything. Like it can choose, in any example that I can tell you, for instance, for the farmer, if the farmer wants 2,000 kilograms of maize, an increase of 2,000 kilograms of maize, he can change the land size, he can change the type of seed, he can change the laborers, he can change anything, right? He's able to do that. So if he's able to do that, then we want to know, how will the farmer know which is the best way, what to combine? Like maybe 1 acre of land or 2 acres of land, and maybe more laborers, fewer laborers. So to produce a given level of output, the firm will choose the input mix with the lowest cost. So this is what is going to guide the one combination. So if all of them give the farmer the same 2,000 kilograms that he wants to upgrade, if I use 2 tractors, 1 acre of land, 3 farmers, I get 2,000 kilograms. If I get 10 farmers, no tractor, but 1 acre of land, I get the same amount. If I increase to 3 acres of land, maybe 3 farmers, 1 tractor, I still get 2,000 kilograms. So which one should I use? So this person has to calculate the cost of each method, each mix, each input mix. The cheapest one is the one this person should go for, because he can afford or she can afford to adjust anyhow. Okay, so the guiding factor is the cost, the one with the lowest cost when you mix the the lowest mix cheap. The input mix combination that is the cheapest or the lowest cost, okay, of all other input mix, okay? So long run total cost is the cost of producing each quantity of output when all inputs are variable and the least cost input mix is chosen. So the one that is chosen, you just add the total cost of each and then you get it. That is the long run total cost. Average total cost, long run average total cost is per unit. So we're going to get the total cost of producing from the inputs, and then we're dividing by the total output. Okay, where all inputs are variable. So remember, this was our long run example, yeah? This was our long run example. I've just brought it here to remind you at this point, this person has a target, a long run target of achieving 300 to 500 units of output to produce. And in the long run, this businesswoman is capable to do any changes to meet this. So we can either have more machines, okay, like those sewing machines. She can have more laborers. Maybe she can have more anything, like she can have anything. So the question is, how many machines and how many laborers to have the cheapest, okay, the cheapest choice. So maybe for her, the headache of going with, you know, how I think, I don't know how this tailor business works, but I don't find a lot of, usually I find fewer workers, fewer laborers in most of tailor, maybe because also they're not so big, okay? So you'd rather have fewer. I find most businesses have fewer tailors. So probably there's a lot of headache or mismanagement when it comes to managing these laborers when there are many. So you find it becomes costlier. I'm not sure, okay? And maybe, you know, having more people with fewer machines, you might not produce as much. So I also see that nowadays also there are very good machines, like modern machines for making these clothes. So someone might have fewer of this and more of invest in very good machines. So it depends which one is cheaper, as long as you're able to meet the same amount of output, but with a cheaper option for you, okay? So here's an example of washing. You remember the cars. So our example with the cars, we had, this was our example, 196 cars. It's because this was a short run. Remember, this is short run. With short run, this person cannot change capital. So could only have 1 capital and 6 amount of labor. Let's go there with this amount of our costs, okay? So here, this would be this point, right? This would be point B. Because point B, capital is 1, this person was not able to change, and labor was 6. So if you times, remember the price of capital is $150. Sorry, this is dollar, okay? My poor handwriting is not very supportive. And then this is $120, okay? So if you multiply each by this, you get the total cost. Remember, we already did this, okay? This is the total cost. Okay, but here, they are varying. Everything is varying. 0, 1, 2, 3. Capital is changing, labor is changing. That's why we are saying we are in the long run. So in the long run, this business person wants to get 196 cars washed in a day. Okay, then we're saying, okay, sir or madam, business owner, you are capable of changing your inputs anyhow. You can use zero capital, no line, no automated line. You just do everything manually. Have 9 labors. 9 times 120, you get this. Okay. Or you can invest in one automated line, just buy one line, and then 6 laborers. They will still wash 196 cars as this option, but the cost is going to be 870. Or you can invest in 2 automated lines, hire 4 laborers, and incur this cost. Or you can invest in 3 lines, hire 3 laborers, and this. So all this will give you the same amount of output you want, which is 196 cars a day. This is the highest you want. You want your production, your firm, your company. This is the highest amount you want to achieve. Like every day, I want my business to wash 196 cars. So these are the different ways that will get you to this target. So what will guide you, because you can afford all this in the long run, you simply choose the one with the lowest cost. So which one has the lowest cost here? Is it this one? Is it this, or this one, right? So this is the best one. This is the best because, okay, so although all of this will give you the same output, but this is the least cost, the one which is cheapest, okay? So if you are the business lady, businessman, so you would rather have 2 automated lines for your car wash business and hire 4 good laborers and incur this cost and wash these cars per day. That's going to be your best option. Okay? That's simple as that. So long run average total cost curves, this is just a way to understand, like it's simply a combination of average total cost curve. So I want to draw the long run average total cost curve. I want to draw the curve. So for you to draw this or to understand this, you have to know the short run, how the short run works. So the short run curve is like, we are drawing, this is the short run curve when the firm had 0 automated line, no line, just from laborers here, like for instance here, okay? So this is when this is an option where a firm has no line. So for you to go for this in the long run, you will choose the lowest one, right? So the lowest point in this one would be here, okay? Then if you add 1 automated line, so for short run, in the short run, you have no choice. You can produce here, 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 or here, anywhere. But in the long run, you choose. So if the option, you will obviously go for the lowest, okay? So let me come here, okay? Let me come here. So let's say you are a business owner for car wash. You want a target. You want to have 130 cars washed every day, 130. So for you to have 130 cars washed, you have many options, okay? You can have, there is this one. This is where there's this point. So any point here, all this will give you 130, right? But then this one is when you have 2 automated lines and the rest is laborers, right? This one, this is the green one, right? The blue one, point B, this is point C. Point B will also give you 130 car washes. This is if you invest in only laborers. This is the blue. The blue is only laborers and 0 automated lines. So everything is manual. This will still give you, okay? But remember, these are the costs per unit. Okay, these are the costs per unit. Remember that, okay? And then point A is red. So red is when you have 1 automated line. So if you invest in 1 automated line and the rest are laborers, you will still also get 130. So as a business owner, you're asking, which one should I use? Which one should I hire? Which option? which input mix is the best. So the one with, we said, the one with the lowest cost. So if you compare the costs, A gives you the lowest cost, okay? Even the graph here, you see here is where it's at the lowest. So for this 130 units, the lowest cost is this. So at this point, you better choose ATC1. Same way, if you go to any point, like if you go to point E, you have this choice and this choice, E or D. All give you 184 units of car washes. But so you have to see which one should you go, the one with the lowest cost, which is going to be this, okay? So if you have, you know, many levels of outputs and many options, that means you're going to take the small, like if you had many curves, imagine you have a lot of options of mixing and mixing and mixing and mixing. So if you take, you will keep on taking the lowest, the lowest, the lowest, low. So you will end up with a big U-shaped curve, which is this one. It's like a big basin, a wide. You see, these other graphs in the short run. In the short run, they are sharp, like they come and, okay. Average variable cost ratio. So if you draw, it's like, but this one, it's like a big trough because it's somehow indirect, like a combination of many short run average total cost. Every time you're faced with a decision, so you consider then the lowest one. So it gives you this huge, trough here. Okay, so now this one has a meaning. Okay, why is it like this? It declines, then it sort of stabilizes, and then it increases. So most firms that have stayed in the industry for a long time, okay, they're in the long run for a while. They've been in the business for a number of years, or like a significant quantity amount of time. They usually go through this phase. So this phase of decreasing long run average total cost, you see they first decrease, that means costs are decreasing. So this phase we call economies of scale, okay? And then when it's this flat, we call it constant returns to scale. And then when it's starting to rise, this is not very good, okay? This is not very good. This is amazing. This is amazing. Like this is where, these are the good days of the company. This is amazing, the boom days of the company. Okay, this is just normal, like, okay. But this one is like things are going south. It's like not, because costs are increasing. So this economies of scale. Okay. So these are just the explanation. Okay. So when you have long run average total cost decreasing, is, so here you see, as output is increasing, costs are supposed to decrease. So when they're decreasing as output is decreasing, that is good. What does this mean is that if you want to double your output, so let's say if you're producing 100 units, this is your total output. Okay, total output, total product, your output is this one, 100 units. And then you want to double it, okay? You want to double. So remember, and so for you to produce this one, you have also your total cost. So let's say you have total cost of 40, all right, to produce 100 units. Okay, so if you double to 200 output, how can cost be? Okay, let's just leave it like that for the example. Okay, so if you want if you want to increase your production to 200 units, to double it, that means the costs you're incurring are also likely to increase. So if you double your costs, but your total cost increase to 1.5. That is less than double. Okay. You can add there and get. Okay. That's gonna be how much? Is it 40? Is it 46? I don't know. Okay, you have to do the math there. Okay. And then okay, let's just do it. Okay. So, what am I doing? So if you take 15/10, 0 and 0, 4 times 5, we get 20. 4 times 4, okay, we get 60. It's 60, right? I think my brain is yeah, I've been here for a while. So, all right, so it's 60, right? So you see, so you double your output, okay, your output, but your costs have increased, but less than double the output. Okay, that's a good thing. Okay, less than double the output. Okay, that is your cost. What if you doubled your output and your costs also doubled? So you have also 40 times 2. So it's 80 now. Okay. So before you had 100 output over 40, you had 0, 0, you had how much? 2.5, right? Now, if you double, your output is 200. If you double, and then the output has also doubled, 40 times 2, I mean cost, sorry. Cost has also doubled to 80 now, so it's 80. So 0, 0, 8. Okay, by 4 you get 2, by 4 you get 5. You get 2.5. So this is where you say constant returns to scale. So there is no change. You plan to expand, you increase your output, the cost also increase by the same amount. It's okay. It's a safe zone. Okay. So if we do the first one was 100 over 40. Okay, we got 2.5. Then we doubled. It was 200 output over less than double was 60, right? So if you divide by 60, you get here 3 point something, right? It's 3 point something. So 2.5 to 3 point something, this is higher. You're gaining. This is a profitable area. It's like a very good area. So let's see now. You are doubling your output. Okay, you're doubling the third scenario. You are doubling your output times 2, but your costs, they triple. Okay, or they more than double, in other words. Okay, so you have now the first one, the first one was 100 over 40. Okay, just repeating, so that even those who are probably as exhausted at this point, you can just go with me. So now, after doubling, it becomes 200, okay, over, this also tripled, it's going to be over 120, right? That's a little bit huge there. So 4 is 5, This is going to be 1.6, I think, 1.6 something. So 1.6 is very low. You know, this is very low compared to what you're getting here. So this is not profitable. So this is what we call diseconomies of scale. The average total cost, sorry, it's supposed to be here. They're disarranged, right? So diseconomies, long run average total cost, they increase as output increases. So you see the total cost was more than 3. It increased more than the increase in output. Okay, I hope that is clear. So that finalizes our, of course, as you go along the book, it gives a bit more of a how they kind of mix up together, and how the long run costs, you know, by using different examples, how they used to explain or they're being showcased. So if you are probably there's something you have not really tapped into or understood very well, please just slowly go back to the lecture. I've really tried to use as many basic examples, but I know, you know, some of you, these concepts are very new to you, but I've used your day-to-day life to kind of understand this concept. That if you feel like it's a bit tough, not very clear, I urge you to, you know, go back. You can Google, you can check on YouTube some of these concepts, you know, Google the meaning of a word or how it's used, what does it mean, and go over and over, you know, look at other examples, marginal returns, what is the marginal product, average product. You know, if you just go into a YouTube video, just look at one concept, you'll be amazed by how probably it's interpreted, explained by somebody else apart from myself. So maybe that will give you a broader understanding. Also, you can go into the textbook and kind of see different examples. So here we're not going into the examples that probably are being showcased there. And, you know, it's also, you know, it's a foreign book. So some of the examples might not be easy to relate with you, but you can go back and just look at those contexts and just understand for the sake of understanding, because they use real-time data to still explain the concepts in as much as they're foreign. So try to follow through, even if it's just one concept, just to understand. And that will be very easy for you. When you have a question, you have to calculate, it's tricky, it's what you're able to just know the whole idea before you get into the question, okay? So that's it for this lecture. Let's meet again for the 6th lecture on profit maximization, all about profit and loss. So bye-bye for now. Until next time.